What is a 10-year Treasury yield? Have you ever wondered how the government borrows money and what that means for your investments? Today, we are going to break down the concept of the 10-year Treasury yield. This yield is the annual interest rate that the United States government pays to borrow money for a period of 10 years. It comes from the issuance of 10-year Treasury notes, which are a type of government debt security. These notes pay a fixed interest rate every 6 months until they mature at the 10-year mark. When you buy a 10-year Treasury note, the yield represents the return you can expect if you hold onto it until it matures. This yield is a key benchmark in financial markets. It influences interest rates for many other types of borrowing, including mortgage rates and corporate bonds. When the yield rises, borrowing costs tend to increase. Conversely, when it falls, borrowing costs usually decrease. This makes the yield a useful indicator of broader economic conditions and investor confidence. For example, if the yield is rising, it may signal optimism about economic growth. On the other hand, a falling yield often indicates caution or concerns about a slowing economy. From a retirement perspective, the 10-year Treasury yield is important because it reflects the risk-free rate of return that investors can earn on a long-term, very low-risk investment. Treasury notes are considered among the safest investments since they are backed by the United States government. Retirees or those planning for retirement often look at the 10-year yield as a benchmark to compare against other investment options, such as dividend growth stocks or corporate bonds. These alternatives typically carry higher risk but also have the potential for higher returns. Understanding the 10-year Treasury yield can help retirees balance their portfolios between safety and growth. For instance, when yields are low, fixed-income investments like Treasury notes offer lower returns. This situation might encourage retirees to consider dividend growth stocks for income and potential capital appreciation. Conversely, when yields are higher, Treasury notes become more attractive as a stable source of income. This helps to preserve capital and reduce portfolio volatility. In essence, the 10-year Treasury yield is the interest rate on a 10-year United States government debt security. It serves as a benchmark for other interest rates and reflects economic sentiment. For retirement planning, it provides a baseline for evaluating the safety and return potential of fixed-income investments compared to higher growth options like dividend growth stocks. Understanding this yield can empower you to make informed decisions about your retirement investments.